Hey friends, Mayhem here with another episode of Mayhem's Macro Monday, sponsored by TraderAid.com, where retail investors and traders can come to learn more about markets. We focus on intermarket analysis, trading, investing strategies and ideas, breaking down the big picture all the way to the minute details in regular weekly video updates. And we also have an exclusive forum for our members, all included in a $20 a month or $200 a year subscription. And then we also offer one-on-one and group coaching and a class that Horse has created specifically focused on day trading the opening range using Bookmap. So check this all out on the web, TraderAid.com. I think you'll like what you see. If you like the type of videos I put out and the tweet content I put out there, there's a lot more of that in long form there as well. But without further ado, I want to break down some of the charts that were the most popular on my Twitter feed this week with some commentary to color them. First, we have the investment into new oil production and how it's declined over the last decade. And this is a big deal because oil is the lifeblood of our economy. It's not just used in energy, it's used in transportation, creation of things like fertilizers, plastics, and other kinds of chemicals. You know, the oil industry and the gas industry as well are pivotal parts. So we're not seeing the exploration and production that we need to really drive more elasticity in our energy supply chain. And that matters because inflation is driven in no small part by high energy prices. And if energy prices are going to rise every time there's even a resurgence in demand that brings us back to near pre-COVID levels, then that kind of puts us into a situation where we can expect inflation to be problematic. And it's not just oil. There's a lack of investment in base metals, in agriculture, and other parts of the economy as well. So these kind of feed into each other. And as we can see over the last couple of years, it's been one of the big drivers of the inflation that consumers have felt all over the world. So we are facing down a recession, a higher cost of capital. These companies are not likely to increase capital expenditures during such an environment. So it's not going to be cured during the down cycle. And if there isn't an impetus to try to invest more in oil companies and go away from some of the sort of ESG stuff that's going on in the here and now, as well as the oppressive regulation, then we're going to have a situation where energy prices could remain artificially high. Because it's not for lack of supply, it's for lack of production exploration. And that's a problem that we could work around if there was the will. And if we're going to get to a renewable energy future, we have to work around those things because that bridge will be built with hydrocarbons. And we look at the Strategic Petroleum Reserve, we can see we only have 27.3 days left. This is a multi-decade low. It's disconcerting that we're dealing with an era of energy scarcity. Artificial scarcity, but scarcity nonetheless. And we're more vulnerable to a systematic energy disruption in the United States than we have been in decades. So, you know, anyone around the world who's not so nice, like Russia perhaps, or China, could see this as a strategic vulnerability. And perhaps it's something they would consider exploiting, and that certainly adds to geopolitical and economic risk. We also see that India and China have more than compensated for the drop in Russia's crude oil exports to the European Union, which still remain incredibly large. But nevertheless, we can see that these sanctions aren't very efficacious because there's appetite for this energy elsewhere, and Russia's willing to sell it below market to make sure that they can get that product out there. So it's not really that these sanctions are having a tremendous impact on Russia's oil industry, which is the country's biggest industry. We can also see the S&P 500 has a pretty strong positive correlation with the central banks of the world's assets, right? Their balance sheets in total. Now, I know there's some chart crime going on here, but ultimately that positive correlation is important because QE has been a big driver of upward price revisions in risk assets like stocks and crypto. And as we see quantitative tightening, that is taking that buoyant bid away. And as a result, it is going to put additional pressure on stocks, on crypto, on other areas of the market like real estate, especially if the Fed starts to sell their mortgage-backed security portfolio. So something to watch very closely here. We can see that we're already having the market start to discount the impact of QT. So I would not underestimate what could happen next if the Fed really is intent on rolling off about $1 trillion a year for the next 3 years, of which, you know, that's about 40% of their treasury exposure. So it's very easy for them to just let those come off at maturity, as most of their treasuries are going to mature by 2024. And then on the mortgage-backed security side, they haven't started to sell those yet, but if they do, again, I think it'll have a deleterious impact on the housing market. So things to consider as we move forward, that the risk in risk assets is to the downside, and that is a pretty fat left tail risk because we have an illiquid market that is losing the lifeblood that helped to support bidding it higher at the same time that we have growing recessionary risk, growing geopolitical risk, and also we have a lot of businesses that are pretty vulnerable, both in terms of their earnings being overestimated moving forward, but also in terms of the macro conditions really playing a negative role. Bear markets also typically take a long time to work through. So this bear market has only been around for just about 160 some days. The next chart, we'll get into that in a little more detail. And the average bear market lasts about a year or so, at least some of the more recent ones. The COVID-19 crash and the 1987 crash weren't really your average bear markets. Everything happened very rapidly. This is a more slow, grinding, painful bear market that's taking time for the sort of orderly deleveraging across multiple assets to play through it. It has everything to do with a combination of a hawkish Fed and a slowing economy. And on top of that, the entire economic cycle, the credit cycle that Fed created, was built on the idea of an ever-expanding supply of debt that is artificially cheap. And so, when you start to reverse that, you raise rates, you make capital more expensive during an environment where everything else is getting more expensive and the economy is slowing, and the recipe is one for disaster, both for equities, but also for bonds, for real estate, for crypto. And so it's something to keep an eye on as we move forward throughout this bear market. Speaking of bear markets, this is the other chart. This bear market's been around for about 164 days. The average bear market certainly lasts a lot longer than that. So it's something to keep in mind. We've also only gone down 23.5%. The average bear market gets down close to 40%. So we could have a little more to go, especially if this bear market is discounting an actual recession. And the equity market performance versus historical periods of crisis and recovery, what we can really see is just over a very long period of time, crisis generally presents opportunity. And we're early in this crisis, so it might be a little too early to consider it an opportunity yet. Furniture spending as a share of total credit card spending is down, both as food spending goes up, energy spending goes up, and people are using their credit cards to pay for their utilities and their mortgages to try to stave off what could be inevitably a catastrophe for many consumers. But the other thing is it shows that people are not buying as much stuff because they're not buying as many homes. And I think that's a sign that the housing market is probably going to soften further here. We also see the evolution of the Atlanta GDP Now real GDP estimate for the second quarter of 2022 now being revised down to negative 2.1% after Friday's ISM data. This would put us in a technical recession, 2 quarters in a row of negative growth. If this ends up being the print, which I think it's going to be pretty bad, that would mean the second quarter not only saw a bigger contraction than the first quarter, but it would also mean that we are now in a technical recession, and that would mean the Fed is engaging in pretty aggressive monetary policy into a technical recession, which is somewhat unprecedented. Doesn't mean they won't do it. They certainly probably will, because inflation seems to be enemy number one. But what it does tell us is this recession could get quite nasty if consumers are this weak now and the Fed is not even really getting the party started. And finally, we'll leave it on a highly optimistic note. German consumer confidence is at multi-decade lows, and this has everything to do with inflation and a negative economic outlook. So, we think things are bad here. We have, historically low consumer confidence here. We also have that in UK. We also have it in Germany. Many countries are seeing their consumers tap out. They just don't have the money to participate anymore. So I just wanted to present all this information to everyone in a way that I hope is helpful. Again, this video is sponsored by TraderAid.com, so check us out on the web and learn more about us. I think it's a pretty great place to cut your teeth, whether you're a experienced trader or whether you're someone that's learning the ropes. And we also have a lot of resources for investors and a lot more coming online. So if you like this content, please like and subscribe if you aren't already. Feel free to share it with your friends and other folks around Twitter, YouTube, and elsewhere. And as always, check me out on Twitter. My handle is Mayhem for Markets, Mayhem number 4 Markets. Thanks again, everyone. I'll talk to you soon.